Hello guys, and welcome to our BPP's tutorial for today. We're still on preschool 1.1, and then what is forex? We've done that. 1.2, how do you trade forex? So we are done with that. We talked about lot sizes, and you actually input your lot sizes. And we talked about a pip. We said a pip is a tick in the movement of chart, and we talked about the types of forex orders as well. If you haven't listened to watch the other video, please go back and do so. Leave your comments if you think I skipped something or you want me to explain something. I'll do another video to go in depth with that. But like I said, when we started this course, I want to get quick through all of this, making you to understand the real most important core basics knowledge you need to understand, you need to know. So we are on 1.6, margin trade 101. Understand how your margin account works. And it's pretty long, as you can see. It has lots of subtopics. However, like we've been doing, I'm still going to go over this really quick in less than 30 minutes, right? And of course, you know, you spend more than an hour, often 2 hours reading all of that. So what is margin trading? The biggest appeal that forex trading offers is the ability to trade with margin. But for many forex traders, margin is a foreign concept, like Bob, boom. So what is margin trading? You remember earlier on we discussed, we said if you want to control a financial instrument that is worth 100,000 units, you must have let's say $100,000 in your account. Let's say, so you do not have that kind of amount of money in your account. However, you want to be able to trade like somebody who owns 100,000 US dollar in his or her account. Now your broker will enable you to put a percentage amount of that money into your account. Your broker will let you deposit like 2%, right, of that amount into your account, and then he will let you trade like you have 100,000 US dollar in your account. So that money which you are putting into your account is called a margin, right? So that's your margin, and then you can be able to trade standard lot sizes like 1.0, whereby if it moves up one tick, it's like $100 or $10 or so, right? $10 or so. Then 10 pips is $100, right? So that is how margin work, right? Now there are lots of terminologies under this. You have to know what they mean, and then we have concepts or words like free margin, and then margin call, and then margin level, what is stop out or margin close out. All of these they are not rocket science, right? They're not difficult to understand. So we're going to go really quick through all of this. By the time you fund your account, if you haven't funded your account before, when you fund your real life account, look at the chart here. This is how it will look like. You have your account balance, you have equity, you have margin, you have free margin, and then margin level. So let's talk about all of this. Now we have equity like this diagram. It's explained down, so let's just really quick go down and take a look, a deeper look, right? Go down. So your balance, by the time you fund your account, when you fund your account, your balance is the amount of money you funded your account with, right? Then your used margin is the number of active trades you have currently that are running. They make up your used margin. Then your free margin is the margin left in your account which you haven't used. Then the unrealized profit or loss, that's the amount of money you haven't made, or whatever you're trading, your live trading activity at that particular moment is saying. If you are up in profit or if you are down in profit, then your equity is a total sum of everything that we have: balance, used margin, free margin, unrealized profit and loss. It appears in your equity column or row. Then the margin level is from 200% to 0. That's just the level of the margin. So we're still going to talk about more about all of this in detail. So let's move on to the first one, what account balance is all about. So your account balance, like we said, when you open your account, is the money that you deposit in your account. It's simple as that. And now we talked about risking your capital. Don't come to forex trading with the mindset of making millions right overnight. No, come with the money that you can afford to lose, right? So don't come with money that you cannot afford to lose. So that's why I also told you, do not open even a demo account. Do not open a demo account with 100,000 US dollars. Put 20. You can trade with 20. That's the beauty of forex. That's why it's more better than stocks, than futures, than every other thing. Forex there's a lot of flexibility in forex. So if you deposit 1,000 US dollars in your account, for instance, your balance is 1,000 US dollars, right? That's it. Then we have rollover, right? We talked about rollover the other time. If you take a trade and you let the trade ride from the first day to the second day, right, you will get either a debit or a credit fee depending on the trade, right? And that's called the rollover. And we talked about the percentages that time, the other time, percentages like 0.06%, 0.02%, depending on the currency pair, right? So that's what rollover is all about, right? And then if you are on your charts, let's look at this chart right here. You see where you see swap fee is for this trade this person carried over for GBP USD, right? It is 0.01. So the person got 1 cent, right, interest rate for carrying out this trade to the following day. So there are some trades basically you take, you get a positive swap fee, and there are some trades you carry over to the following day, you get a negative swap fee. So look at this bottom line here. You see balance, you see equity, you see margin 1.28, and you see free margin 1,000.04. Then margin level, the margin level is 778.413. Lots of margin. Why? Because this person is using a very great leverage. So this is the person's account balance. You see, even though the person has 1,000 US dollar in his or her account, the person is trading 0.01 lot size. So it means if the chart ticks by just one tick, he's making 1 cent, just 1 cent, and that's good risk management. Why? Because he's not going to lose a lot of his money, of his capital, right? So he's been trading this trade for over a day plus now. He's just making 11 bucks. So when you continually do things like this consistently, risking very well, wisely, protect your risk, your account balance, you're going to grow exponentially. You're going to have phenomenal results. So what is unrealized profit and floating profit or loss? Let's just go down deep into it. Unrealized profit, floating loss, and floating profit. Basically, right, we're not going to talk about all of this mathematics and discuss all of that. We don't have that time. Your unrealized profit is the money that is running on your trades. You have not, closed a trade, and the trade is still active, right, live. So that's money that is live, that is running live right there online, that you haven't withdrawn to your account. Either it is profitable to you or it's a loss to you. That's your unrealized profit and loss. Now in MT4, MetaTrader 4, which you'll be using to trade, you're not going to see PL and FL and all that. It's just going to show you your account balance. Let's look at this chart again. Previously, where is it? It's going to show you this here. Look at my mouse, right? It's just going to show you profits. That's all. It's not going to show you PL, which is profit and loss, or unrealized profit and loss in your MetaTrader account. No, you're not going to see that. What you're going to see is your profit. So if it is negative, that's your unrealized loss. right? Unrealized profit or loss. If it is positive, which you are seeing 11 plus, if it is negative, it will be showing you minus 11.15. So that's how your live account is going to look like. So, and that's one of the reasons why I say we're not going to dive into, try to break down PL and read all this stuff right here. In a nutshell, this is what it is. And like I said, this is a crash course. So unless you want to take your time to read all through this, you still come back to what I have said and what I have shown to you in that example. It is what it is. You're not going to see PL or FL or whatever. Then what is margin? We've talked about margin the other time, right? If you want to control 100,000 worth of financial instruments, right, and you do not have 100,000 worth of 100,000 US dollar in your account, your broker will allow you to deposit 3,000 US dollar in your account, right? And then you choose a leverage that will enable you to take a trade that somebody who has 100,000 US dollar in his or her account, whereas you do not have that kind of money in your account. So that is this 3,000 US dollar you are putting in your account is your margin. Sing that, just sing that, right? There's no more to it. Margin requirements and all of this. Okay, the percentages requirements for the pairs, right? Like that you want to trade. These are the percentages. So what is the margin required? The margin required is the amount of money that you need to put in your account in order for you to be able to control a specific worth of financial instruments. So for 100,000 US dollar and you want to trade the Euro USD, you put 2% of this money into your account, which is 2,000 US dollars. So that is it. That is it. If it is for USD JPY you want to trade, there's an amount of money you have to put into your account. Let's say 10,000 worth of financial units you want to control. Put $400 in your account and you can trade that. So this is how much. This is just how it is, right? Do not bug yourself with all of this, right? Let's move ahead. What is margin used? Margin used is the amount of money that has left your account, right, and is running on the live chart. The money you have put right there that is running, that is your margin used, right? So let's not read and try and calculate all of this. You can come back and do that again, but I can bet you you still come back to understand that what I have said is what it is. So what is your equity? Your equity is the total sum of your account, your balance, your account balance, your floating margin or floating profit or floating losses, everything that is in your account, the whole worth of financial instruments in your account is called your equity, right? So either you are in profit or you are in loss, right? Your equity gives you everything that will be after you close your trading for the day. So let's say, for instance, if you have a balance of 1,000 US dollar and you came to the market, your account balance was 1,000 US dollar, right? And you took a trade, and the trade is currently running in a loss of $50 dollar, right? Your equity will be 950 US dollars. So that's what equity is all about. And if you understand that, and that it is simple as it is, you are not going to try to come back to read all this word for word. I can promise you, when you go to the live chat, it's exactly what you're going to see. What is free margin? We've talked about used margin, right? Or free margin. Okay, let's just read. Used margin, which is just the aggregate of all the required margin from all open positions. I explained that. Now the free margin is the difference between the equity and the used margin. The margin that is left for you in your account, right? That is the free margin. How to calculate free margin? Do you really need to calculate free margin? You don't need to, because your broker does this for you automatically. Like as you are trading, right, and you're looking at your chart, all right, underneath there, your broker is doing all the calculations for you automatically, right? So Do we have to come and calculate a margin, use margin, free margin? You do not need to do that unless you're like Bob, you want to stress yourself. No, because your broker does all of this for you, right? If you know how to calculate, how to take your lot sizes, how to use proper leverage, you are good to go. What is margin level? Like I said the other time, a margin level begins from 0 to 200, right? So it depends on your margin size and the leverage that you are using, that your margin level will become incremental or become decreased. Now, so let's just read this. It says margin level is equal to your equity divided by your used margin multiplied by 100. So again, are you really going to calculate all of this while trading? No. Why? Because your broker does that automatically for you as your trades are running. So you'll basically be seeing your margin level live while you are trading. So do you really need to come and calculate and study all this? Unless you have the lot of time and energy to do that. It's very simple. Just know what you're doing, look at it on the chart, right, and you're good to go. So margin level from 0 to 200, right? And it's like a traffic light, right? We're going to talk about that when you have margin call and all that, what they do. Okay, here we go. What is a margin call level? Now, a margin call level is a situation whereby your trades, right, are going negative. Like you are from 100 or 200 margin level, which is a peak, and you are trading on a live chart, on a live market rather, and then you are in so much loss, right? So when your losses are coming down to 150%, 100%, you get a margin call, right? And if it gets to 50%, your trades are automatically closed out by your broker. Why? Because your margin level, you have exhausted the required margin that you should have in your account balance to enable you to take a trade, right? So margin call level versus margin call, right? What brokers do, that's time passed, right? They will send you, they will give you a margin call. It depends, right? They like a normal call, right? And you receive the call and they tell you, well, your margin level is down, you should exit all your trades right now. And if you do not exit your trades, they begin to close you out, right? And when does a margin call actually occur? That is when your margin level has dropped greatly. So a 100% level, they might give you a call, and 50% they stop you out of all your trades, right? This happens, right? However, will your broker actually call you in this 2020 and henceforth? No, your broker do not do that. Once your margin level is terribly dropping down, what you'll be seeing in your dashboard, right, when you're trading, you'll be seeing a red flash on the trading, on your equity bar. You'll be seeing a red flash, like it will be like signaling, boom, blinking, telling you your account is terribly low, you should close your trade right now and all that. However, if you do not do so and you continue to trade, they might stop you out depending on your margin level and your leverage, or you just go out and blow your account. So what is a stop out level? That's when they close all your trades. That's when your broker close all of your trades because your margin level is terribly low. Your trades will just be automatically closed. So they stop you out all of your trades, and you are going to lose all those monies that you have lost while trading. You cost it yourself, right? So what is all this? You really look at all this. Let's say you have $1,000 in your account, and your margin is floating at minus 960, right? And your equity is 40, which is the total sum of your trading account, right? you are floating in a profit or loss, which is minus 960, where you see profit, right? That's P profit section the other time I showed you. So your broker will definitely close you out. There are some leverages you will use, they will close you out, but your trade will just go on, and the trade continues to go against you. Your account will be zero. Yes, I have seen that before. That's happened to me severally. I let my trades ride, hoping the market will come back in my favor. It didn't come back in my favor, and I blew my account. Bro, we all blow accounts. We've blown accounts, right? But blow your account wisely, learn from it, and pick yourself up again and go back to the chart. So look at this here. We see your margin level 100%. Your equity is $200. Used margin is $200, which is currently floating in the market. Free margin is zero. Your account balance is 1,000. Profit or loss is 800. So why do we have 800 here? Because you have used $200 and you are negative 800, and as a result of that your equity is just $200, right? And so when your margin level gets to 20%, you get a margin call or you get stopped out. And if you do not get stopped out, what will happen is that you have a zero account balance of $40 left. Yeah, it's as simple as that. So if you have different positions opened while you are trading, you will be closed out. The most highest loss, right? Say you have $1,000 in your account, right? Say you have $1,000, your account balance is $1,000, and you have 5 trades open, and one trade is running at $700 loss, and another trade is running at $50 loss, 20, just like that. The very first trade that is running at $700 loss, that's like you are about like 30% left in your margin level, right? 30% left. So your broker will close out that $700 loss that you already you have incurred, so as to save your account from crashing. So your broker will do that for you, and then yeah, subsequently, if the other trades go in losses as well, they will continue to be stopping you out gradually until they save something for you in your account. They actually do that for you. So the trading scenario, margin call at level 100, they just give you a call. They say your margin is level 100, and they give you a call. Like I have said, today in 2020, no broker will pick his phone or her phone to call you. How many other traders are they going to call? And they don't even send you an email. What they send you at the end of the day is your trading account, profit or loss, your account history after the day's trading. So they send it to you automatically via email. So that's what you get. Step 4, calculate equity. We know we've talked about equity, and we've told you your broker does all of this for you. Calculate your margin level. We've told you your broker does this for you as well. What is here? And this is just a chart, and that shows that as well. So there's pretty used margin. We've talked about that. Your account that is currently running, and that's your used margin. Floating profit and loss. We've talked about that as well. That's the amount of money you are making or you are losing currently on the live market. Your equity is the total sum of everything that you have done or you are doing. Your free margin is what is left for you. Your margin level, that's the percentages of your trade account until you get stopped out or until you get called, unless you went ahead and completely destroyed your account, right? It happens. Sometimes when your emotions gets to you, right, you just sit back. I've done that. I'll just sit back and watch them and watch the market, take out all of my trade because I'm upset and all that. It happens. You're going to learn about all of this. You'll learn about yourself as you continue to trade forex. Like I said, it's not a day something, and don't just start forex and put in $500 and all that. Unless you have somebody coaching you, giving you trades and say take this and take that, right, as you continue to learn. But if you do not have somebody doing that for you, right, don't just go and put $500 in your account. You will burn it down. I promise you, you will burn it down. You want to start trading, right? Put $20. Put $20. Not because it's cheap, not because it's little money, right? But because you want to try to grow that 20 to 40 or to 30, and see how excited you become when you do that, and see how quickly you lose it as well because you're excited. It's a lot of things that goes on. Trading scenario: margin call level at 100% and stop level at 50%. So what happens if your margin gets to 100%? They let you know, and if you go down to 50% of that, they stop you out of all your trades. That's exactly what it is. Like I said, we are not going to. Most of all this usually happens. This kind of scenario usually happens when you're trading futures and stocks, right? Your stockbroker will call you, hey, this and that. I haven't done stock before, so I don't know how stock works. But I'm telling you, in Forex, I haven't received a call from my broker in no time, even though while my account is burning down, while I burnt it down, right? So it is what it is. Calculate your equity again and all that. I've told you all of this is done for you automatically by your broker once you are in the live market. So you really don't need to come and read all of these to see how it is. Floating profit and loss is the current amount of money that is running on your live trade. Once you go live, you'll be seeing your live trade. You see your profit, your loss, your margin, your equity, and everything. You see them live there, right? So like I said, this is a crash course, and we are not going to read all of this because we know already what they all stand for, right? So unless you have the time to come out and just read again to verify that what I am saying is true, then move to the next level. Trading scenario: what happens if you trade with just 100 US dollar? Nothing happens. When you trade with just 100 US dollar, make sure you have very good make sure you have a good leverage, right? And once you have a very good leverage, don't go and pick 50 to ratio 1. Pick something like 500 to ratio 1, 600 to ratio 1, and you see that your margin level will exponentially become so huge, right? And when you choose something like that, then take lot sizes of like 0.01 or 0.02, like the other chart we looked at the other time, the other diagram. You saw somebody with account of $1,000 is taking a lot size of 0.01. Oh my goodness, I would not do that anyway. Well, I will confidently take a lot size of 0.05. 0.05. Yes, I'll do that. So that is what it is all about. So let's just go quickly. Where are we now? Account metrics. All of this is done for you by your broker. Okay, so congratulations if you are following this course. Know that you are learning all this super fast, and you are not missing out at all. Nothing at all. You are not missing out on nothing. Okay, this is warning. Different forex brokers have different margin call and stop out levels. It is true. Where are we here? Warning. Okay, we have 3 levels to go. Yes, so your broker, it depends, especially if your leverage will determine when your broker stop you out and the number of trades you'll be able to take. So if you have for instance, you are controlling 100,000 worth of financial units, right? And you have 2,000 US dollar in your account, right? If your account goes below 1,000, you get a call or a warning message from a broker, right? You get a message from a broker. If your account goes down more than 1,000, let's say you are negative 1,300 US dollar, your account balance is, your equity is 700 US dollar, your broker will stop you out of your trade because your margin level and your free margin is not able to carry out on the trade anymore. So what you have to do for you to continue to trade, you have to go back to your account and switch your leverage. So you have to move your leverage from 50 to ratio 1 to like 200 to ratio 1, and then you can't take a lot size of 1 anymore because 1 is $10 per pip, right? 100 pips is $100. 10 pips is $100. 20 pips is $200, right? So if you move 100 pips against you, that's 1,000 US dollars. So your account burns down quickly, right? So the relationship between margin and leverage. This is what we'll be talking about. Your leverage and your margin, they works hand in hand, right? So let's see, if the leverage provided for this trade, let's say, okay, let's just go back a little bit. For example, if you wanted to trade one standard lot of UEJ without margin, you need 100,000 in your account, right? But with a margin requirement of just 1%, you would only have to deposit 1,000 in your account. So the leverage provided for this trade is 100 to ratio 1, right? Here's examples of leverage ratio depending on the margin requirement. So for a standard lot, you have to take leverage of 50 to ratio 1. You put $1,000 in your account. You can trade the standard lot size of 1. That's $10 per pip, right? 5 pips, 5 ticks. Like if the chart moves 5 times up, yes, if the chart moves 5 times down, right, against you, that's $50. If it goes up in your direction, that's $50 in profit, right? You see this trade we put here yesterday. If we had taken this trade here by now, what would have happened? The market would have come back down 300 and something pips, and then go back up, and then it's trying to push down again. So this is how basically the market works. So let's go back to what we're doing. Yeah, so this is how it works. So I will also give you a sheet, right, of leverage and the lot sizes you have to use. I will post it. I will provide the link in the description of this video. So margin jargon sheet. Margin is the amount of money you are required to deposit with your trading platform in order to order and maintain positions in the forex market. Wow. The margin is used as collateral to ensure you can cover any losses you might incur on your positions. Yes, your leverage is the ability to trade a larger amount with much smaller amounts in your account. Unrealized profit or loss is the current profit or loss held in your open positions. It's also called floating profit or loss. Balance is the money you put in your account. Margin requirement per position is the amount of margin required to open a position, right? And then a margin required per position, if you open a 10,000 mini lot position with a required margin of 2% or 50 to ratio 1 leverage, $200 will be locked up during the duration of the trade. So you need to put $200 in your account, which is the margin required for you to trade or control a financial instrument of worth $10,000 US. And then it is also called entry margin and all of this and all of that. You will not see all this in your MetaTrader 4 when you are trading, right? So margin level, you want to see your margin level. Like I said, your broker calculates all of this for you, instantly once you're in the live market. So how to avoid margin call? The simple way to avoid margin call is to trade with good lot sizes. So if you have a $200 in your account, don't go and pick a margin leverage of 50 to ratio 1 because you want to control financial instruments worth 10,000 units and you'll be taking trade. No, you want to burn your account in 10 pips against you, your account is gone. Okay, so if you have $200 in your account, pick a leverage of say 500 to 1 or 200 to ratio 1 or 300 to ratio 1 or even 600 to ratio 1, and then take a lot size of 0.01 or 0.02, right? That's how you should be trading. And that's how you are going to avoid margin call. Because if the trade goes against you, say 100 pips, that will be like $1 or $2. And will you be disturbed about that if you lose it $1 or $2 from your $200 worth of account? No. You'll not be disturbed because you have $191 left, or you have $198 left in your account. Your account is pretty much very good. Nobody is going to call you. Your broker is not going to call you. So, in conclusions, there are 5 ways to avoid margin call. Pay attention to currency pairs you are trading and their margin requirements. Know when to cut your losses so you can trade another day exactly, right? And all that. Know when to exit the trade. Use proper risk management. History of retail forex trading. when did this start? Once the market was decentralized, right, the history forex became more open to many people. Name the best things the mighty powers of the internet have brought us: YouTube, Facebook, Netflix, TikTok, reviews.com. Yeah, so that's when retail trading came into being as well. So it's been a very not very quite long, pretty long ago to be, but it's been so decentralized that everybody can take part in it. So forex broker types: dealing desk and no dealing desk. Oh my goodness. Dealing desk. Okay, this is another section, and this is kindergarten. So we are done with how to avoid margin call. This is the end of preschool. Yeah! Congratulations.